Hello everyone, Professor Reiko here, continuing on with our chapter on accounting for income taxes. So this video is a little bit longer. We're going to do a example where we really focus on our reconciliation from financial income to taxable income. We're going to look how things start to reverse out over time and see how that affects our journal entry going forward, and just some other new stuff. So this year's a multi-year example. We're still going to stick with just one either deferred tax liability or deferred tax asset in this one, but we'll get rolling on it. And this one's a little bit more common example dealing with depreciation. All right, so we got a company started operations in 2006. They compute pre-tax financial income of $75,000. So that's my FI. That's accounting before income taxes. The only difference between financial accounting and taxable income is depreciation. So depreciation is a common example. All right, so here's what they say. They use straight line for financial reporting, and then if you've taken a tax class yet, you know that they'll use an accelerated method on the tax return. Okay, so what that means is we have two different types of depreciation. We're still going to depreciate the asset fully over the life of the asset, so at the end, total depreciation will be the same. However, it's going to be a different amount each year. So these are temporary differences that we've been talking about that will reverse out over time. Okay, how is it going to reverse out? So the difference is $15,000. All right, and here's how it's going to reverse out. So if you sum that up, you get $15,000. All right, so typically before we move on, I'm going to scroll down here. I do this in class. This is nothing you would have to do on a test or know as far as for me, but I think it helps to see where this is coming from. All right, so this asset that we're dealing with, like I said, you don't have to know this, but I think it helps. All right, so it's a $40,000 asset, and it has a 4-year useful life and no salvage value. All right, so on my financial statements and on my tax return, I'm going to depreciate, and then I'm going to have a difference. All right, so we buy this in 2006, and then we depreciate it over 4 years. All right, so it says up at the top that they use straight line depreciation for financial income. So that just means this is $10,000 each period. It's $40,000 minus 0 salvage value divided by 4 is $10,000. All right, so we can see at the end of the time, the 4 years, it will be fully depreciated. All right, now the problem gives us the differences, so we can back into what the depreciation is on the tax return. So $25,000 the first year gives rise to that $15,000 difference. All right, so notice we're depreciating way more on the tax return. All right, so our taxable income will be affected by that, and that will affect our reconciliation here in a second. All right, and then it reverses out. So depreciation the next year will be 8, so that is that $2,000 difference reversing out. Then it says there's a $4,000 difference, so that means it would have been 6. And then this is 1,000, giving that difference of 9. So once again, we're fully depreciating the asset, and there's no difference at the end. All right. So like I said, you don't necessarily have to know that, but I think it does help to see that, have it illustrated, so you kind of understand what asset we're dealing with. So once again, notice we depreciate way more on the front end, and then less and less as we go off. As we move down, it gets smaller and smaller because it's an accelerated method, which means we depreciate it quicker and then less in the later years of the asset's life. All right, so let's get back to the problem. All right, so we've got the enacted tax rate is 40%. We keep that for all the years. All right, so one of the most important steps that you can do is this reconciliation. So I'm not sure how your teacher approaches this, but I put a lot of emphasis on this because if you can do this reconciliation, the numbers kind of for the journal entry should pretty much flow from this. All right, so remember, a reconciliation, this isn't a financial statement or anything like that. A reconciliation is how do I get from point A to point B? What happened to get me there? All right, I'm starting with financial income. All right, so financial income, I'm going to scroll down a little bit here. So financial income, if you come down here, look at it, in 2006, includes $10,000 of depreciation. Okay, so there's $10,000 depreciation included in that. However, I'm trying to get to taxable income, which has $25,000, okay, of depreciation. So we have this difference of $15,000 here. All right, the question is, do I add it or subtract it in the reconciliation? All right, well, let's walk through this. if I have more, so I have 25,000 of depreciation on my tax return. All right, so that means I'm subtracting a bigger number. All right, I'm subtracting 25 as a deduction as opposed to 10,000 of depreciation expense that I'm doing on my financial statements. All right, so if I'm subtracting a bigger number, that means my taxable income will be smaller because I'm subtracting a bigger number. Therefore, in my reconciliation, think about it. This includes this up here in the 75, we subtracted 10,000. If I subtract 15,000 more, it will give me the 25,000 right here, and that's what would have been shown in my tax return. Okay, so very important step. So let me just scroll up to the top. This is something I do in my class as well. This will help you quite a bit. Let me find, I've got some room right here. All right, so if you think about it, we have taxable amounts less deductions gives me taxable income. All right. So if I was to have more taxable amounts, meaning more income on my tax return, my taxable income would be higher. All right. If I was to have less, my taxable income would be smaller. If I was to have more deductions, meaning I'm subtracting more things, all right, I'd have less taxable income. And if I have fewer deductions, my taxable income would be higher. All right, so the example that we are in is this column right here. All right, and then remember let me just finish here. All right, so the reason I do this, I think this up here, the first couple lines, that's pretty conceptually, that's easy to understand, right? If I have more taxable income, if I have more taxable amounts, I'm going to have a higher income. Okay, that makes sense conceptually because we understand, you know, revenues less expenses on our tax return, we call them taxable amounts less deductions. All right, if you can remember this, what I'm circling here, the pluses and minuses, that's what you do on the reconciliation. Okay, so notice for this column it said we subtract, and that's what we did down here is we subtracted. All right, now I'll walk through these all conceptually, but if you kind of get this into your head and understand this portion conceptually, it will help you with the reconciliation. Now, if we subtract it on the bottom, it's a DTL. If we add it on the bottom, it's a DTA. So if we look back at some of the things we've already done, we did that warranty example in a prior video. All right, and we ended up with a deferred tax asset. All right, we'll have these are over, and this will be like accrued expenses will fall under this category. This first one will be any of our unearned revenues, which we did at the beginning. This will be like installment sales. All right, so kind of get this picture in your mind, and I'll write it on future videos as well because I use it as a shortcut, and I think the students benefit from it. All right, so we said it's a DTL, but once again, if we apply our rule here, taxable income compared to financial income, all right, taxable income is less, therefore we are paying less now. We are going to pay the $24,000, because remember that's just income, taxable income times the tax rate gives me the payable. All right, so that means, oops, sorry. So that means it's a DTL. All right, if we're paying less now, that means we'll pay more in the future when it reverses out, and we're going to actually see it reverse out in this example. All right, so now we're ready to do our journal entry. Once we have income tax payable, all right, so remember our deferred tax liability is 15,000. I mean, our difference is 15, so we're going to take the tax on that, 15 times 40% when we do our journal entry. So when you get time for the journal entry, remember, you can always just sketch it out before you even worry about numbers. We know we have a DTL. All right, and so it's going to look, this journal entry, we'll do this over and over again. We said this was 24,000. All right, the DTL, remember, it's the tax on the difference. The difference is the difference is 15,000. All right, so that is 6,000. And then our income tax expense by definition is just the net of our current and deferred taxes, and that's what we've got there. All right, so let's switch over to the top of the next page. And we have this, what their financial statements will look like. So let's just sketch this out real quick. So remember, the financial income was 75,000. Okay, and then we have our current and deferred taxes, giving us income tax expense of 30. And once again, if you get confused, make sure this number matches up with the journal entry, which it does from the previous page. Gives me net income of 45,000. And then we'd have our current liability of 24,000 and our deferred tax liability of 6,000. some teachers and some books may take this deferred tax liability and split it up into a current and deferred portion, meaning what is going to reverse out next year is current, what is going to reverse out longer than next year as the non-current. So just kind of pay attention to what your teacher expects of you in that situation. All right, so let's go forward 1 year. Now in class I'll just go on and do all 4 years, but just for the sake of time here, we'll just do 1 year. All right, so we're going to keep financial income at $75,000. So we got to do our reconciliation here. All right, but now things are we don't have a new difference. We have this $2,000 difference. This comes from the previous page. This is now it reversing out. Okay, so we're not creating anything new. We're just reversing it out. So remember, we said earlier we're going to pay more in the future. Now we're paying more in the future as it reverses out. This will be $30,800. All right, so my journal entry will be income tax expense. This isn't a deferred tax asset since I added it here. This is the reduction of a deferred tax liability and income tax payable. All right, so we said that was $30,800. Remember, this is the tax on the difference, which is $800. So income tax expense is the net of the current and deferred taxes. All right, so we've got the $30,800 there. All right. So once again, if you think about our DTL, so we created it with 6,000. We just reduced it by 800. So the balance going forward is 5,200. All right. Now in class, I will go on and do the next 2 years, but just for the sake of time, I'm going to stop here. But what we'll see here is if you were to carry it this on for the next 2 years, you would end up being zero after the 4 years, meaning it would fully reverse out, and that DTL would be zero. Right. So this is just an example of one deferred amount. It was a deferred tax liability dealing with depreciation, but we started to see how it reverses out over time. Okay, so what we'll do now is we'll continue to add things in. We'll start having more than one thing. And we're going to add in permanent differences as well to our future examples. So we still have some more stuff to add in, and then we'll worry about changing tax rates and things like that. All right. So I know this video was a little bit longer, but needed to kind of explain a few things. Remember that shortcut. If you struggle with that, kind of try to walk through that conceptually. I will refer to it in future videos as well, and so hopefully it will start to kind of take shape with you, that you be something you can use to your advantage come test time, right, when you're doing these reconciliations. So we'll do more of these, so stay tuned in. Please subscribe to the channel. It does help me. Please share these with your friends. Hopefully it will help them have a better grasp on some of these issues that we're dealing with for income taxes. All right, see you next time. Thanks.